Every war has a price tag. You just never see the invoice. That's not an accident. That's the design. Think about the last major conflict you can remember. What did it cost you personally? Probably nothing obvious. No extra line on your tax return, no government official showing up at your door asking for a check. Markets maybe dipped for a week, then bounced back. Defense stocks actually went up. Politicians got on TV and told everyone the country was strong enough to handle it. And most people believed them, because why wouldn't they? The grocery store was still open, the paycheck still cleared. But here's what nobody said out loud. Wars are almost never actually paid for when they happen. They're financed. And that one word, financed, changes absolutely everything about who ends up holding the bill. Stick with me here, because by the end of this, you're going to look at your energy bill, your rent, your grocery receipt completely differently. Let's go back, way back, because war used to hurt immediately, and honestly, that was almost better. Medieval kings had exactly 3 moves when they wanted to go to war: raise taxes, seize land, or shave down the coins. Literally mix silver with cheaper metals, hand it back to people, and pretend nothing changed. Classic. Whatever option they picked, the pain showed up fast. The peasants felt it within weeks. No delay, no abstraction, just less food, higher prices, angry people. Take the 100 Years' War. England versus France, 1337 all the way to 1453. Over a century of bleeding each other dry. And funding it? Monarchs squeezing merchants, squeezing clergy, squeezing landowners, basically squeezing anyone who had anything left to squeeze. The fiscal pressure got so bad that revolts weren't occasional, they were practically scheduled. War was visibly, brutally expensive, and everyone from the king to the farmer knew exactly why their life had gotten worse. Spain learned this the even harder way. Charles V, Philip II, endless military campaigns burning through money across Europe and the Americas. And they had a silver mine, literally, entire fleets hauling silver out of the New World. And it still wasn't enough. The Spanish crown defaulted on its debts in 1557, then again in 1575, then again in 1596. 3 sovereign defaults in less than 40 years. Military ambition kept writing checks that revenue couldn't cash. Back then, the system had a natural break. You want war? You take money from someone now, immediately, visibly. And visible pain creates resistance. Resistance limits ambition. Then came 1694, and that break quietly stopped working. The Bank of England was founded that year. And look, on the surface, it sounds boring. Another financial institution, but what it actually did was revolutionary in the worst possible way. For the first time, a government could borrow at massive scale from private lenders, backed by the promise of future tax revenue. Instead of squeezing everyone up front, Britain could issue bonds, long-term promises, pay us back later, with interest. Investors lined up. Wars against France, the War of Spanish Succession, and eventually the Napoleonic Wars, got funded not by immediate confiscation, but by borrowing against decades that hadn't happened yet. By the time Napoleon was finally done in 1815, Britain's debt had climbed above 200% of GDP. 200%! That number would send modern financial journalists into full cardiac arrest. But Britain didn't collapse, because the innovation wasn't the debt itself, it was the structure. Consols, they were called, perpetual bonds. The government paid interest forever, without ever needing to repay the principal. The burden transformed from a visible punch in the face into a long, slow, barely noticeable squeeze across generations. And once governments figured out that wars could be funded this way, there was no going back. Fast forward to the American Civil War. The Union is hemorrhaging money, so they issue war bonds. Fine. But they also start printing paper currency, greenbacks, not backed by gold, just paper backed by trust. And what happened? Inflation. Prices climbed. The war's cost didn't show up as a tax on your pay, it showed up as your dollar buying less at the market. World War I scaled this to something almost incomprehensible. Governments across Europe buried themselves in bond issuance. In America, Liberty Bond posters were everywhere. Buying bonds wasn't just smart, it was patriotic. Nothing says voluntary like social pressure from your government during wartime. And people bought them. It worked. But bonds alone couldn't cover it, so governments suspended the gold standard, expanded the money supply, and inflation came roaring in across Europe. In Germany, it didn't just roar, it detonated. By 1923, hyperinflation had essentially vaporized the savings of an entire middle class. The mark became worthless. People were literally wheeling cash in barrows to buy bread. Life savings? Gone. Not stolen, not taxed, just diluted into nothing. Here's the thing that rarely gets said directly. Inflation isn't a side effect of war financing. It's one of the primary methods of war financing. When taxes aren't enough and borrowing gets expensive, governments expand the money supply. They print. And printing quietly reduces what every existing unit of currency can actually buy. There's no invoice, no line item, but it is absolutely 100% extraction. Just extraction with better PR. World War II ran the same playbook with more sophistication. U.S. federal debt exploded from roughly 40% of GDP in 1941 to over 120% by 1946. And after the war, did they slash it with massive tax hikes? Not exactly. Instead, they deployed something quieter, something that barely has a name most people recognize: financial repression. Here's how it worked. Interest rates got kept artificially low. Inflation ran higher than those rates. So if your government bond was yielding 2% and inflation was running at 4%, you were losing purchasing power every single year. You thought you were saving. You were actually subsidizing the debt. The government repaid its loans in dollars that were worth less than the dollars it borrowed. Neat trick, right? Not a conspiracy, just arithmetic. And governments, being the biggest debtors in existence, benefited enormously. Savers absorbed the loss, quietly, incrementally, across decades. Now here's where you need to pay attention, because there's a pattern forming, and once you see it, you can't unsee it. Debt pushes the cost forward through time, inflation pushes it downward through society, financial repression smooths it out over decades so nobody notices until it's already done. And it does not land equally. It never has. Think about Weimar Germany in 1923. If you were holding cash, you were ruined. If you held foreign assets or real property, you survived. Different story entirely. Or consider the United States in the 1970s. Inflation, partly fueled by Vietnam War spending plus oil shocks, eroded purchasing power for ordinary wage earners. But people holding oil-producing assets or commodities, they were having a completely different experience of that same decade. This is the structural reality of war financing. The mechanism itself prevents equality. It is built in.
Consider what happened during World War II on the corporate side. General Motors, Boeing, Lockheed, these companies pivoted to wartime production and were flooded with government contracts. Production boomed. Profits surged in certain sectors. America's industrial base came out of that war bigger and more dominant than when it went in. Now jump to the post-9/11 wars in Afghanistan and Iraq. Trillions in expenditures. And companies like Halliburton, Lockheed Martin, Raytheon received massive contracts. Their share prices reflected that demand. Investors holding those equities didn't experience war as a drain. They experienced it as a revenue stream. This isn't about villains. It's about structure. When a government floods money into a specific sector, capital follows. Asset owners in that sector benefit. That's just how the plumbing works. Now, contrast that with the average salaried worker during those same periods of wartime inflation. Wages lag. They always lag. Housing costs go up. Energy goes up. Food goes up. If your salary rises 2 or 3% and your actual expenses inflate by 6 or 8, you absorb that gap personally. No memo, no explanation, just less month at the end of your money. Inflation is taxation without legislation, and like most taxes in practice, it hits harder the less financial armor you're wearing. Own real assets, property, equities, commodities, and you have some protection. Hold cash savings in a low-interest account while inflation runs above it, you lose, quietly, year after year. Here's what's genuinely remarkable, though, and this is the part that Money Never Learns was basically built to explain. Modern wars feel cheap because the cost is hidden inside abstraction. There are no emergency war taxes stamped across your paycheck. What there is a deficit that quietly widens, a central bank balance sheet that quietly expands, a treasury auction that gets quietly larger. After 2001, the United States entered 2 wars without raising broad-based taxes to pay for them. Federal debt doubled between 2001 and 2008. The bill didn't disappear, it just got deferred, put on a credit card with a very, very long statement date. And that credit card does eventually send a statement. Debt has to be serviced. Interest payments have to be made before anything else gets funded. As debt accumulates, it narrows what governments can actually do. It creates pressure to keep interest rates low because high rates on massive debt loads become a fiscal catastrophe in their own right. And when inflation eventually surges, central banks face an impossible choice: let it run and erode purchasing power further, or raise rates and stress a financial system built on cheap money. You watched this exact dilemma play out in 2022 and 2023. Massive spending, supply disruptions, geopolitical tensions, money supply expansion, and then inflation across the Western world that the official explanations kept attributing purely to supply chains. Supply chains mattered, but underneath, when governments spend aggressively and finance it through debt that central banks accommodate, purchasing power shifts. It always shifts, and it always shifts away from people holding currency. The United States right now carries federal debt exceeding 120% of GDP. Annual interest payments have become one of the largest single line items in the entire federal budget. That's money that has to leave before teachers get paid, before bridges get fixed, before anything new gets funded. The wars that generated chunks of that debt are over. The bill is still running. This is the final arithmetic that most people never connect. The soldiers go to the front. The bill goes to everyone else, spread across years, tucked inside price levels, buried in bond yields, diffused across generations who had absolutely no vote in the original decision. You probably haven't seen a war tax on your paycheck, but you've seen grocery bills climb, rent climb, energy climb. You've watched deficits expand into the trillions and wondered vaguely why everything costs more than it used to. That's not a coincidence. That's the accounting ledger of geopolitical ambition, and you're one of the line items. Understanding this doesn't require cynicism. It requires clarity. When you see how wars actually get paid for, a few things become obvious. Holding only cash in an inflationary environment isn't safe. It's a guaranteed slow loss. Debt at national scale creates structural incentives that almost always protect asset owners and absorb costs through wage earners. And the people who design these financial systems, they tend not to design them to punish themselves. The pattern across centuries is remarkably consistent. Governments borrow, central banks accommodate, currency weakens, real assets adjust upward in nominal terms, wages lag, wealth concentrates, and the invoice arrives so quietly, so gradually, that most people never connect the bill to the decision that created it. Spain defaulted 3 times in 40 years and still kept fighting wars. Britain borrowed to 200% of GDP and called it innovation. The United States doubled its national debt in 7 years and barely interrupted the news cycle. Different centuries, same playbook, same result. War is almost never paid for by the people who declare it. It's paid for, slowly, invisibly, across years by the people who hold currency and depend on wages, while those with assets ride the inflation upward. The mechanism isn't broken, it's working exactly as designed. And as for whether we've learned anything from 1,000 years of this pattern, well, you're watching a channel called Money Never Learns. You already know the answer. If you'd rather see the next one coming before it hits your wallet, subscribe button's right there. Most people won't. Most people never do. But then again, most people are still surprised every single time.